Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Gregg Kaplan, Derivatives Portfolio Specialist at Audent Global Asset Management, to discuss his outlook going into 2021 and the current macro and political backdrop. Gregg, it's great to see you as always. Welcome back to Trade Talks.
Hey, Jill. Thanks very much, and good to see you too.
Before we get into 2021, let's discuss December trends and what your outlook is, considering it's typically a positive month.
Yeah, and we do look at this. Typically in December, what we see is about a 1.5% gain over the last 70 years. We don't see that changing this month. What we do see out of this December is we think more people are going to take money off the table. But we see a calm December. We're not going to see everyone going on vacation in 2 weeks and kind of leaving. But with that said, we see a normal December here.
What signals are you getting from the VIX? Clearly, it's depressed from the March and April highs in 2020, but on a historical basis, there's still a little bit of juice there.
Thanks for asking, Jill. There's a lot of juice. The VIX is something I watch every day, every second, to be honest with you. 20 VIX or 21 VIX is still high. Let's not forget that. If you even go back 10 years, the VIX got as low as 9, sometimes 9 or 10, right? So 20 would be considered high. And it only peaked above then 4 or 5 times, right? So that implies volatility in the market. That implies still concern in the market. And if you look even further out to the August VIX, it's about 25. So there can still be some moves. We'll consider it normal, but there's still some fear in the market. And that concerns us.
Do you think the next 3 to 6 months will be challenging for the market to choose direction? So we have to get through COVID-19, we have the administration transition. You know, there's a couple macro factors out there.
Yes, with the administration change, we weight that into our models, but not like extensively. We think there was a gasp of air. And a lot of hot air came out of the market, and we look forward to the administration change. We understand that the House and Senate are different parties, and we don't know how they'll work together. But we don't think that's the driver in the market. The real driver is a pandemic economy. And with that said, we don't know how long the scarring will go on. We don't know how long it's going to take for the real economy to recover. There's that disconnect between the real economy and the stock market, and travel, leisure, entertainment, restaurants, hospitality, gaming. We don't know the outlook. We're optimistic and we have our toe in the water, but we're cautious on any move in direction, just because the COVID tunnel is so murky.
Well, let's talk about the companies that benefited from the pandemic, whether you want to call it work from home, work from anywhere trade at this point. The Nasdaq 100 leaders, those kinds of stocks, your Zooms, Peloton, all the FANG stocks, all of them. Do you expect them to continue to thrive regardless of COVID-19 or not? I mean, these feel like the new economy stocks.
Yeah, we do. We like those stocks, the newer pandemic stocks. We do like them, and we don't see them slowing down. People just don't adjust overnight. If you like your Peloton, you're not quitting Peloton. So we don't see that changing in the use of Zoom. We don't see that changing. We like those stocks, but more importantly, we like the old drivers, which are true benefits of this economy, right? Your Microsofts, your Adobes, your NVIDIAs, they were truly almost designed for this economy. You have new users who are all using these heavy tech products, and you have old users who are using it even more. So I see the old ones continuing to really thrive despite PEs, and I see the new ones thriving as well.
How about deep value, or are they deep value for a reason?
In some cases, they're deep value for a reason. But we also have our toe in some deep value stocks. We think companies like Boeing, that was accelerated before COVID, right? They had issues before COVID. But we look at that company as a deep value company, especially in the defense space, right? And down 26, still down 26% on the year, with the S&P up 14%. There's value. Coca-Cola is down 5% of the year on the year. Again, S&P up 14%. We look at that as long-term value. The same with Procter & Gamble. That up 9% on the year. Who's not using their products still? I think there's play there. So we really still like them as well.
And Greg, to wrap up, as active managers, how are you approaching this environment?
Thanks for asking, Jill. As active managers, we actually use a ton of options in our portfolios. So we use options to protect our portfolios, to add cash flow, and to really define outcomes. And so through the use of the options market, we sleep well at night. But more so is, we can take advantage of fear and euphoria and actively manage our accounts using the option component. So don't get me wrong, we like appreciation, but through the use of active management of options, taking gains and losses quickly and hedging our portfolio, we sleep a lot better at night.
All right, Greg, appreciate the insight. Thanks for joining us on Trade Talks.
Yeah, thanks. Good to see you again.
You got it. Same here. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Have a great night.